In this part, I'll be showing you my intraday trading setups. The first trading setup which I'll show you is called the volume accumulation setup. It's my most favorite setup of all the setups, and it is based on the fact that volumes are accumulated in price channel or in a rotation, as I said before when I was talking about the price action. So when there is a price channel or rotation, volumes are being accumulated. Big banks or big financial institutions are accumulating their positions in rotation. And after rotation, there's a trend. This is quite usual behavior. First, there is rotation where volumes are accumulated, and then there is a trend where the big institutions are actually making money. And basically the volume accumulation setup consists of volume accumulation area, in other words the rotation area, followed by a trend. So whenever you see volume accumulation in a rotation followed by a trend, then you can start looking for the volume accumulation setup. So here are rules for the entry setup. I won't be talking about position management yet, but I'll be talking about it later, alright? So this part will be only about entering the trade. So here are the steps for the volume accumulation setup. First, you look for rotation, which is followed by a trend. So if you look at the picture, you can see that there is a rotation, price is moving sideways, big institutions are accumulating their positions, and afterwards there is a trend. Alright, so this is what you look for, rotation followed by a trend. Next step, what you want to do is you identify where the heaviest volumes got accumulated within the rotation area. So you use the flexible profile, or you can also use the fixed profiles, but in this case it's probably better to use the flexible profile and you stretch it over the whole rotation area. So you stretch it over this area. This is the rotation area. Alright? It doesn't matter if you stretch it over the trend as well, because you are interested in the volumes in the rotation area, which will show nicely. Alright, so in this picture, in this rotation, you can see that there were heavy volumes accumulated there, and the heaviest volumes, absolutely heaviest volumes within this rotation were in here, at this price level. This is the point of control of this rotation. Heaviest volumes, which means that the institutions accumulated most of their volumes at this price level. So what you do next is you draw a line from this point of control, from the place where the volumes were the heaviest, and wait for the price to return to this level again. So you are waiting. You can use limit orders or you can set some alarms, but you do nothing until the price reaches this level again. And when it hits the level, you don't wait for any sort of confirmation. You enter your trade at first hit. Alright, and you enter in the direction of the trend. So in this case there was a downtrend which followed the rotation, so you'll be entering a short. If there was a rotation followed by uptrend, pullback, then from this place, from the place where the volumes were the heaviest, you would be going long. Alright? So this is how the setup looks like. And the logic behind the setup is this. In this rotation, volumes got accumulated. By the time that the rotation got created, you don't know if volumes in this area were buyers or sellers. I know that there are some profiles, some volume profiles around, which sort of tell you if there are more buyers or sellers, but those are basically just fake numbers. You can't really tell if there were really buyers or sellers. Alright? So you can't really tell if there were buyers or sellers in here. But if there is a selling activity afterwards, if there's selling activity after the rotation, you can tell that in this place sellers were accumulating their selling positions. If there was an uptrend afterwards, after the rotation, then it was buyers who were accumulating their positions there. Alright, so you can tell by the movement which occurs afterwards. And when the price returns to the level again, to the place where the heavy volumes get accumulated, the reason there's a reaction is that those sellers are defending their selling positions and they are trying to push the price downwards aggressively to protect their positions. Alright, this is reason number one. Sellers protecting their positions. Or if it was an uptrend, then it would be buyers protecting their positions. Now, reason number two why this setup works is that when the buyers are pushing the price upwards toward the level, then they know that there were strong sellers in here, and it is risky for them to try and push the price through the level, because those sellers are likely to start selling and fighting the buyers who are pushing the price upwards. So it is risky. It is risky for the buyers to fight them in here. So the buyers are likely to quit their positions in here. They start quitting their positions, and by quitting their positions, the price starts to move in this direction. This is sellers quitting their positions. Alright, so it's not only those sellers fighting and selling aggressively, it's also the buyers who are pushing price upwards, getting rid of their positions and selling them. Alright, so both parties are selling. Buyers are selling, and those sellers who are defending their selling positions are also selling. And it's combination of those two that pushes the price downwards. You can never tell if it's the buyers getting rid of their positions or if it is the sellers getting rid of their positions or who is doing more of the selling. But the important thing is that institutions are selling and it's pushing price downwards. Alright, so those were the two reasons and the logic behind this trading setup. This is another example of the trading setup. I'll show you more of them in the next video on live charts, but just to make it clear, this is a rotation followed by a strong downtrend, meaning that within this rotation, strong sellers were accumulating their selling positions. So what you do is you draw a line from the place where the volumes were the heaviest within the rotation, which was in here. This was the point of control of the rotation, and you are waiting. You wait for the price to return back to this price level, and you go short from there. Alright? Now there are three things you need to be careful about. First, levels which are already tested. So if there is a rotation like this, and from the rotation a trend starts, but the price returns to the rotation and trend continues, then the rotation, the volumes in the rotation or the level is already tested. It got tested in here with this movement. Alright, so if the price went out of the rotation, quickly tested the level and went into the buying activity, went into an uptrend or a downtrend, it doesn't matter. The level is already spent. It got tested in here. Alright? So in this case, when the price returns back to the level, you don't trade it. You discard the level. You trade only the first test. Unfortunately, the first one was in here, so you don't trade the second one. Second thing which you need to be careful about are weak highs or lows or failed auctions. So if there is some rotation, but it's sort of weak low in here, then it's very risky to enter the level in the rotation, to enter the long from there. It's very risky because weak low is a magnet and the price tends to shoot past it, past the weak low, to create a strong low. Something like this. Alright, so it's very risky to go against weak low or weak high, which is the same, only reversed. And the same goes for failed auctions. So if there's some rotation, and let's say that in the rotation there are candles like those two ending at the same price level like this, then this is a failed auction. And if there is buying activity afterwards and then the price returns back to the heavy volumes created within the rotation, then you don't go long from the level because the price is likely to go downwards to test below this failed auction and create a successful auction. Alright, so if there is weak high or weak low or a failed auction, it's quite risky to enter your trade. So always watch out for those. The last thing to be careful about is the levels which go clearly counter strong trend. Meaning, if there is a strong uptrend, then there is some rotation and some selling activity. Not strong, but only like moderate selling activity, moderate downtrend. And then the price quickly reverses, and let's say this is the level. Alright, let's say that the heaviest volumes in this rotation are in here. Then it's very risky to enter short in here because it's counter strong trend, and especially if there is a weak high like this one. This would be extremely risky to go short from. And also, if there is strong rejection of lower prices in here and the price is aggressively going upwards towards the level, this would be really crazy to enter short there. So you always want to look for the bigger picture, see where the big trend is, and not to enter crazy trades like that. Alright? Always look in a bigger picture when planning your intraday trades. Alright, so that's the theory behind the volume accumulation setup, and in the next video I'll show you some real examples in the live charts.